By the end of the 1990s, the world had 2 decades of intermittent financial crisis. And so the question was, what's the best way of surviving in this world? If I was a developing country operating in the global economy today, I would be screaming out for the 2 major economies to be coordinating more and cooperating more in order to support global demand. If you go back to the Bretton Woods monetary system, well, all the reserve currencies had capital controls. It just happens to be a historical regularity that the country that prints the top currency tends to be the top military power. And as long as the US is the top military power, I think that makes it difficult to shift the attractiveness of the dollar as a kind of linchpin international currency.
Welcome to the European Guanxi podcast. Today we're very honored to have with us David Lubin, who is the Michael Klein Senior Research Fellow at Chatham House and was previously a managing director and the head of emerging markets at Citibank. David, thank you so much for coming on the podcast.
Thank you very much for having me.
So today we're going to talk about the global financial system and China's capital controls, its current account surplus, the internationalization of the RMB, China's landing, and how all of that fits into the broader story of international capital. So in your book, which is called The Dance of the Trillions, you describe this dance of capital, like money flowing into and out of developing countries. And today we want to, as I said, look at where China fits into the story of development finance and the history of international capital. So we're going to talk about how China manages capital flows, how it controls financial risks, and how it navigates its place in the global financial system. So I want to start off by understanding why China controls the capital that flows in and out of the country. Why does China have capital controls? And if you could link it a little bit to what Beijing perceives as good capital, like FDI, and bad capital, which is speculative financial short-term flows.
Thank you very much for that introduction. I guess you could ask the question, why isn't it the case that more countries don't have capital controls? Because in a way, the history of the last 4 or 5 decades is one in which developing countries have been, in a sense, the victims of the volatility of capital flows as they move across the globe. Now, of course, external financing, which is just another way of using the phrase capital, external financing can be extremely important for developing countries, both in an arithmetic sense. In other words, if you're importing more than you're exporting, you need to finance that difference. And so you depend just arithmetically on getting capital in from abroad. So if you have an external financing gap, then you need capital. There's also a sort of non-arithmetic sense in which developing countries should, in a sense, be dependent on external capital, because capital in the form of foreign direct investment can transfer technology, can improve skills, can help raise productivity levels in developing countries. And so you're left with this sense that there is a kind of hierarchy of capital flows in the international financial system. And I think that at the top of that hierarchy, in other words, the most valuable form of capital by far is foreign direct investment. When foreign direct investment comes in, it's kind of bolted down into a country's economy, and the income flows the income flows that FDI generates, in theory at least, are, if you like, pro-cyclical. In other words, when the economy is growing, firms within that economy are making money, and so the economy as a whole can afford the capital outflows, the dividend outflows, or the investment income outflows that the foreign owner of the capital that's been established in a developing country wants to repatriate. That by contrast, more volatile forms of capital, particularly, portfolio inflows into the very short end of a country's yield curve, or to some extent cross-border bank lending. These forms of capital flow in the past have proved to be much more volatile, much more jumpy with respect to changes in global risk appetite, and therefore, in a sense, much less productive for the developing country that's on the receiving end of those more volatile forms of capital. And so, it's given rise to a long-standing debate about whether developing countries should prevent the inflow of speculative forms of hot money in the first place as a way of minimizing the volatility of those flows, or whether developing countries should adopt a different strategy to accommodate or to protect themselves against some of the negative aspects of the volatility of capital movements.
Could you talk a little bit about China in specific and why it maybe doesn't need foreign capital? You already said that because of its current account surplus, it doesn't have to finance imports. But what is special about China that means it already has enough money to invest? It doesn't need capital from abroad that much.
Well, I think, again, if I can go back to that distinction between sort of the arithmetic need and the sort of economic need for capital. From an arithmetic point of view, China has had current account surpluses, for decades. And so it doesn't have an external financing gap in the way that a country running a current account deficit would have an external financing gap. So from that purely kind of arithmetic point of view, China doesn't need capital. But during the early stages of the reform and opening up, of course, FDI inflows, which, as I remember, reached a peak of some 3% of GDP in the 1990s and early 2000s, those FDI flows were extremely important for the Chinese economy in terms of their ability to establish Chinese manufacturing, to transfer technology, and to raise levels of productivity throughout the economy. So, again, China's a perfect example in a way of that difference between the arithmetic need for external financing and the real need for financing.
I want to go through some thought experiments and some counterfactuals to get to know what would happen, for example, if China liberalized its capital controls. So let's look at that. What if China got rid of its capital controls? I think in a previous interview you mentioned that at the moment China has more capital that wants to flow out of China than into China. So what would that scenario look like? Would the renminbi even depreciate more? Would that lead to more Chinese exports? What do you think would happen if China got rid of its capital controls?
I think my hunch is that what I'd said earlier remains true. In other words, if overnight all of China's capital controls were removed and China went from being an economy with capital controls to one without, then there would be a very substantial capital outflow. So the exchange rate would strengthen, the exchange rate would weaken because there's more money in China that wants to explore the rest of the world than at the moment there is money in the rest of the world that wants to explore China. But again, another distinction that might be worthwhile here is the distinction between the overall demand for foreign exchange, or the overall demand for foreign portfolio diversification, and the effective demand. And what I mean by that distinction is that because of the persistence of capital controls, because particularly since 2017, the implementation of China's capital controls has been so strict, there's just, you don't see what you might normally see in a country where there's kind of excess demand for foreign diversification. What you might normally see is the opening up of a parallel foreign exchange market. Now, that doesn't exist in China as it does, for example, in Ethiopia or Nigeria or somewhere. So the sort of effective demand for foreign exchange is well contained in China. There's no parallel market. There's no obvious sense in which Chinese households are scrambling to get their hands on dollars. But I think that that fact aside, the fact that the sort of the effective demand for foreign exchange is relatively well contained, sits alongside the fact that the overall demand for foreign exchange, or the overall demand for foreign portfolio diversification, my hunch is still rather high because of the the persistence of capital controls in China.
So does that mean that all those countries that complain about China's overcapacity, they would not want a liberalization of capital controls because of the, resulting depreciation of the renminbi in that case?
Yes, that's a very good point. If if capital controls were to be completely abandoned in China, and if that was followed by a substantial depreciation of the renminbi, then Chinese export competitiveness, which in any case has been greatly enhanced in the last few years by a more or less 20% depreciation of the real trade-weighted exchange rate of the renminbi. So what is already a very, very competitive renminbi would become even more competitive. And so I think you're right. The persistence of Chinese capital controls not only suits Chinese policymakers, but at the moment it very much suits the rest of the world too.
Okay. So let's explore the other direction then. What if Beijing took measures to appreciate its currency? That could, for example, serve its goal of internationalizing the renminbi, because with a stronger currency, China would be able to import more from abroad, renminbi flowing out into the world, contributing to the renminbi potentially becoming a global reserve currency. At the same time, the strengthening of the renminbi would strengthen the buying power of Chinese consumers, addressing this long-standing problem of Chinese underconsumption that economists have been going on about for quite many years. So in such a world, what are the potential benefits for China and what are the risks? And why does China, at least at the moment, does not seem to want to take that path at all?
I have a slightly different understanding of how exchange rate appreciation in China would support the internationalization of the renminbi. I don't think it's quite so much to do with what you were saying, that that a stronger renminbi would cause Chinese people to import more, and therefore there'd be greater liabilities, renminbi-denominated liabilities offshore. It's more to do with the fact that if I'm importing, if I'm in China and you're selling me something and I say to you, can I pay you in renminbi? Then your inclination to say yes will be maximized if you believe that you're not going to lose money holding those renminbi balances. So a moderate currency appreciation supports internationalization because it just encourages people to encourages China's trading partners to have more confidence in receiving renminbi balances because they won't lose money. In fact, the experiment that China has been conducting over the last 10 or 15 years in internationalizing the renminbi by promoting its use as a means of exchange, which is really what we're talking about here, that experiment has had its ups and downs according to what's happened to Chinese exchange rate policy. So, for example, in the years 2012 to 2015, when the renminbi was strengthening and everybody assumed that it was going to continue to strengthen, the use of the renminbi as a means of settling China's trade transactions with its trading partners went up very dramatically, because China's trading partners were very happy to receive renminbi because everybody thought it was going to strengthen. And then in 2015, when the foreign exchange market in China underwent some wobbles, the international confidence in holding renminbi balances went down. In the last few years, let's say since 2018, things have improved again, and it's now the case that around 30% of China's trade transactions are settled in renminbi. And so, I think a moderately strengthening renminbi is an important underpinning for the promotion of the currency as a settlement currency, and to internationalize the currency through promoting the renminbi as a means of exchange. But there is a trade-off, and the trade-off really is as follows: there's an external objective contrasting with an internal objective. The external objective is to internationalize the renminbi, and fulfilling that objective kind of requires a moderately strengthening currency. However, as China gets closer to achieving that external objective, there's an internal objective, namely avoiding deflation, which becomes more and more difficult. China, although we're speaking in the middle of November, we've just had the inflation rate published for October, and it was positive. But for many months of 2025, the inflation rate in China has been negative. And that deflationary trend, which may be structural, or at least has some structural characteristics, that deflationary kind of tendency in the Chinese economy will be reinforced if the currency continues to strengthen, because that makes imports cheaper, and that the lower cost of imports kind of spreads through into the pricing structure across the economy. So the Chinese policymakers do have a bit of a dilemma in this sense. On the one hand, a stronger renminbi supports the external objective of internationalizing the currency, but at the same time, it has the negative consequence of entrenching China's deflation problem. I mean, in theory, I guess, the way out of that, the way to resolve that dilemma is to understand accurately why China has a deflation problem and act on it. And there are really two alternative explanations, or two side-by-side explanations as to why deflation might become entrenched. One is a kind of supply-side explanation, which is that China has an oversupply of goods in EVs and steel and cement and lithium solar panels and all the rest of it. And at the moment, this anti-involution campaign that was really established in July is an attempt to, if you like, it's a kind of self-imposed stagflation. The Chinese authorities are trying to restrict output of these goods in oversupply in an effort to raise the prices of those goods. So it's a way of addressing deflation by addressing the supply side of the economy. But actually, in my view, Chinese deflation is more a demand side problem. And so if China really wants to address the deflation problem, or address the risk of deflation in China becoming entrenched, then boosting domestic demand is more likely to be an effective way of offsetting the deflationary consequences of allowing the renminbi to strengthen.
Very interesting. Let's talk a little bit more about the internationalization of the renminbi, which is arguably one of the policy goals of Beijing. What, generally speaking, you already mentioned some, what generally speaking are the challenges that prevent the internationalization of the RMB and becoming the RMB and prevents the RMB from becoming a global reserve currency?
I guess there's one way of answering your question is that there's kind of something on the US side that helps to answer your question, something on the Chinese side. On the Chinese side, it's just it's a kind of norm or a standard or a convention of the international monetary system that we currently live in, that a reserve currency needs to be free of capital controls. All of the major reserve currencies, dollar, euro, sterling, Japanese yen, Swiss franc, Canadian dollar, Australian dollar, these currencies are all free of capital controls. So on the Chinese side, one major constraint in the internationalization of the renminbi is the fact that the renminbi still has all these capital controls. Now, I emphasize that this is a norm and a standard, a convention of the international monetary system that we currently have, because it's not true by definition that an international currency has to be free of capital controls. If you go back to the Bretton Woods monetary system that the world had in the decades after the Second World War, well, all the reserve currencies had capital controls. The US had capital controls, France and the UK had capital controls. So it's not true by definition that a reserve currency has to be fully convertible. It just happens to be true within the context of the international monetary system that we currently have, that it's true. So that's one set of thoughts. And then the other thing that kind of limits the rise of the renminbi in the current international monetary system is the fact that we have the dollar, and the dollar doesn't need to be kind of reinvented, or at least doesn't need to be reinvented right now. And there is this sense, and I guess the sort of technical point that I'm getting at is the way in which, I guess there are two important factors that support the continuance of the dollar's central role in the international monetary system. One is the fact that it just happens to be a historical regularity that the country that prints the top currency tends to be the top military power. And as long as the US is the top military power, I think that makes it difficult to shift the sort of the attractiveness of the dollar as a kind of linchpin international currency. And I guess connected to that is the way the use of international currencies in the international monetary system is subject to a lot of inertia. And by inertia, what I mean is just, you get used to using one technology and it's very difficult or costly to move to a different technology. The best, clearest kind of example, the clearest way of explaining this is to think about the analogy between the way we use the dollar in the international monetary system and the way we use the QWERTY keyboard on our laptops. It's possible to imagine that we might converge to a different kind of keyboard, but it would take a lot of effort and a lot of retraining and reconfiguring the way we think about things to move to a different kind of keyboard. Similarly, it's perfectly easy to imagine moving to a different kind of international monetary system, moving to an international monetary system where the use of the dollar diminishes, but it's a difficult thing. It's a difficult transition to make because it involves households and firms and governments getting used to a different way of doing things, and that imposes costs.
Yeah. So Beijing has tried to pay some of its imports, maybe oil from Saudi Arabia, in renminbi, and I don't know if some countries pay for Chinese exports in renminbi as well. But what are the challenges there? Why can China and another bilateral trade partner not use either the renminbi or another local currency for their exchanges?
Well, I think you've described exactly China's strategy. Roughly speaking, there are two ways you can internationalize your currency. One is to promote your currency as a store of value. In other words, to raise the use of your currency in global foreign exchange reserves that countries and firms and banks use to kind of as a store of wealth. From that point of view, the renminbi still only accounts for about 2% of global foreign exchange reserves. And so the renminbi's effective use as a global store of value remains really very limited. But the other way of internationalizing your currency, rather than promoting its use as a store of value, is to promote its use as a means of exchange. And that is the strategy that the Chinese have adopted. And as I said earlier, in the last few years, that strategy has been once again, gaining credibility in the sense that around a third of China's trade is now settled in renminbi. I'm not sure, to be honest. Maybe somebody should write in and correct me. I'm not sure if the Chinese data split the use of the renminbi between use to settle imports and use to settle exports. My hunch is that most of that 30%, most of that third of China's trade that's settled in renminbi is on the import side. In other words, it's Chinese importing stuff and paying in renminbi to import stuff. But yeah, let somebody correct me if I'm wrong. There's no reason why that strategy should not continue to deliver some achievements for Beijing, particularly since there's one kind of parallel strategy that China seems to be adopting, particularly with respect to some developing countries, which is initiatives that have been discussed in Kenya and Ethiopia recently to swap dollar-denominated debt that is owed to China into renminbi-denominated debt. And so the use of the renminbi is being kind of moved from the current account of the balance of payments to the capital account of the balance of payments in some developing countries. And I think, that's a kind of, I guess I would say it's the latest step, or the latest new step, as far as I know, that Beijing is taking to kind of add more pillars to its strategy to internationalize the renminbi.
Interesting. I mean, if the current deflationary problems of the renminbi continue, that could be, if the renminbi appreciates, then if your debt is denominated in renminbi, that could be harmful, right?
Yes, that's right. But it at the same time, it kind of encourages you to generate income in renminbi. So if you have liabilities in renminbi, it kind of becomes it creates a new set of incentives for a country. If you've got liabilities in renminbi, you want income in renminbi, and so you're therefore more likely to accept renminbi, for anything, for any goods that you're selling to China, and so it kind of puts a new wheel on the car, if you like, and kind of it's an accelerant.
Okay. I want to go back a little bit to your book again, since there's so much historical richness in there, and I want to explore a little bit if there are not some lessons, some parallels, some historical analogies that we can learn from for the challenges we face today. So let's maybe first go back to this. One might almost call it an obsession of not only developing countries at this point to have a current account surplus. In your book, you call it wrapping up warmly, which was very important for many developing countries. Having a couple account surplus had a lot of advantages, and it was sort of one of the lessons that developing countries drew from the debt crises in the 80s and 90s. So could you talk a little bit about why many countries in the world are so keen on having a current account surplus, and how does that relate to the history of the financial crisis in developing countries?
Can I just slightly tweak your definition of wrapping up warmly?
Yeah.
I mean, if I step back a bit, the point is this: the international financial system is characterized by huge volatility of capital movements. That volatility is, historically, at least in the last few decades, primarily driven by changes in US monetary conditions. When US monetary conditions are loose, that tends to push capital towards developing countries. And when US monetary conditions tighten, because the dollar is strengthening, because US interest rates are going up, that tends to suck capital back from developing countries back to the United States. So that's the sort of the basic kind of, volatility framework. And wrapping up warmly. And then the question is, okay, if you're a developing country, what is the best way to survive that volatility? What's the best way to manage that volatility? Well, one answer is to say, well, we should just limit capital flows volatility in the first place. And the way you do that is by controlling capital movements. So a developing country might limit the inflow of capital in the first place by taxing it, by imposing reserve requirements, by imposing maturity restrictions on foreign money coming in. So that's one way of doing it. As it turned out, in the late 1990s, when the volatility of capital flows, or the debates about the volatility of capital flows, were becoming very poignant in the context of the Asian crisis, and before that the Mexican crisis, and before that the Latin American debt crisis in the 1980s. So by the end of the 1990s, the world had 2 decades of intermittent, or the developing world had 2 decades of intermittent financial crisis. And so the question was, what's the best way of surviving in this world? And at that time, there were 2 possible answers, as you said. One is impose capital controls and prevent the volatility of capital movements by stopping the money coming in the first place. That's not the strategy that was adopted. The strategy that was adopted is what I call in the book, thank you for mentioning it, wrapping up warmly. But wrapping up warmly doesn't necessarily involve running a current account surplus. In fact, the way wrapping up warmly was kind of defined at the end of the 1990s and the beginning of the 2000s was more to do with the accumulation of foreign exchange reserves. In other words, if capital movements are going to be volatile and if developing countries are going to be subject to sudden outflows of capital that might leave them financially vulnerable, then it might make sense to have a stash of dollars that you can rely on to kind of accommodate those periods of capital outflow. And so accumulating foreign exchange reserves became the sort of central goal of developing countries trying to achieve some basic level of international financial security. The sort of best or the most famous rule of thumb that came out of that period was called the Guidotti rule, after a deputy finance minister in Argentina, who came up with the idea that a good rule of thumb for a developing country would be to have a stock of foreign exchange reserves sufficient to pay for 1 year of debt repayments. So that, if for whatever reason, if US interest rates went up, or for whatever reason, international investors lose risk appetite and a developing country therefore has no access to international capital markets, then at least it's got enough dollars in the drawer to be able to kind of, pay its way. Now, a current account surplus that you mentioned is not irrelevant to this, because one way in which, a current account surplus does two things. First of all, it limits your need for external financing in the first place, and so your sort of baseline level of vulnerability is kind of capped by running a current account surplus. But the other consequence of a current account surplus is that you have excess foreign exchange. You're earning more foreign exchange than you're spending, and so you can use that current account surplus to finance the build-up of foreign exchange reserves, or as we're seeing in China in the last couple of years, you use that current account surplus to finance a capital outflow. What we're seeing recently in China is a very large outflow of foreign direct investment, amounting to something like $200 billion in recent quarters, annualized, which is just a way, if you have a surplus, that surplus has to be recycled. One way you can recycle it is to accumulate foreign exchange reserves, but the other way you can recycle it is to accumulate assets abroad, which in a way is just another way of describing what an FDI outflow is.
And do you think that strategy of, at least partly running current account surpluses, that has become more difficult in these days with some might call it neo-mercantilism, the decision of the United States that they will not be a net importer in goods anymore. They want to become a manufacturing hub again. So is it more difficult these days for developing countries?
Not yet. Not yet, just because, as a matter of fact, I mean, I may be getting these numbers wrong, and again, somebody should write to me and correct me. But at the moment, as I remember, the US import bill is running at around $300 billion a month, which is, there was a sharp increase in the second quarter of this year when US importers were, buying a lot more stuff from abroad in anticipation of tariffs coming into effect. But the level of US imports has settled down at a very high level. So there's no evidence at the moment that Donald Trump's willingness to shrink the trade deficit, which he sees as a kind of, as a symbol of the loss of US masculinity or something like that. There's no evidence that the trade deficit in the United States is shrinking in any meaningful way. And so in some sense, the US remains as the sort of the consumer of last resort, or the importer of last resort. And for many countries, that's good news, because one of the problems that I think certainly developing countries face is that there's what I've called in the past a kind of clash of mercantilisms. On the one hand, you've got the United States, or this administration saying, we don't want to be the importer of last resort anymore. We don't want to be running a big trade deficit. We want to, start running a surplus, or at least a much smaller trade deficit. But on the other side, you've got the Chinese economy that is characterized by an insufficiency of demand and an excess of supply. And so, the Chinese import bill is, let me put it this way, the US wants to import less and the Chinese are importing less. Or I'm not putting it very well, but what if I was a developing country operating in the global economy today, I would be screaming out for the two major economies to be coordinating more and cooperating more in order to support global demand. Because at the moment, you've got this kind of clash of mercantilisms where China is an economy that I think prioritizes supply over demand, and that generates a trade surplus. And so from the point of view of developing countries in the global system, China is kind of not stepping up to the plate, if you like, as a responsible supporter of the global economy, at least from the demand side. And the United States is saying that we don't want to be a responsible importer. We don't want to be the importer of last resort. We want, in effect, what the United States is saying is that they want to have an economy that is a bit more like China's, and so you're left with this kind of, again, from the point of view of the world's developing countries, a terribly suboptimal situation where the two of the great powers are kind of competing with each other to import less.
Yeah. This brings me a little bit to some analogies I thought I could see in some historical incidents. Something that I found interesting to compare was after the first oil crisis, the petrodollars, the huge amount of money that the OPEC countries got, which they then had to recycle and which in part flowed into developing countries. I thought about whether that could be compared to the BRI, to China getting so much money from its export surplus, which it then, recycled into the world, into railways and bridges and whatnot. So where do you see the key parallels and also the key differences between these two things?
Gosh, that's a very interesting question. I mean, yes, the Belt and Road Initiative was born of China having more dollars than it knew what to do with. I mean, I'm putting it flippantly, but that the Belt and Road Initiative was overwhelmingly financed in dollars. The renminbi was never a meaningful currency as a financing tool in the Belt and Road Initiative, and so the Belt and Road Initiative, the China's ability to fulfill its objectives in the Belt and Road Initiative was, to a large part dependent on the dollars that it had available. And that's why, for example, after there was a large capital outflow in 2015 and 2016, when China's foreign exchange reserves during that 2-year period went from $4 trillion to $3 trillion at a time when, the Chinese economy became suddenly very vulnerable. The equity market, the foreign exchange market in China were subject to a lot of volatility, and so confidence levels dropped. There was a large capital outflow, and by the end of 2016, China, I think, realized that maybe it didn't have as plentiful a supply of dollars to fulfill its objectives in the Belt and Road Initiative as it did previously. And so after 2016, 2017, you can see that the outflows from China in the context of the Belt and Road Initiative fell very sharply. And I think one reason why those Belt and Road Initiative outflows fell sharply is because the capital outflow that shrunk China's foreign exchange reserves in 2015, 2016 meant that Beijing had fewer dollar resources with which to play. And so the Belt and Road Initiative was always a kind of hostage, if you like, to the availability of dollars that China had access to, because the renminbi then and still is not a super important global currency.
Yeah, interesting. And then maybe the second parallel I thought is sort of the second stage of that. After the petrodollars, we had the third world debt crisis, right? And these days, again, we might not be facing a developing country debt crisis, but we're talking a lot about sovereign debt and about even debt trap diplomacy and so on. I don't want to get into that.
Yeah.
So where do you see is there some similarity there where the difference is? And if we can conclude with that, what lessons can we then draw from the history of the third world debt crisis for the current situation of developing countries?
Lots of good questions there. The first point I would make is that actually developing countries, so I was talking earlier about the 1980s and 1990s, and you had this kind of 20-year period in which there was kind of intermittent financial crisis. Countries and policymakers were kind of wrestling with the question, how do we manage the volatility of capital flows? How do we survive in an international monetary system that's characterized by so much capital flow volatility? And the answer they came up with was wrap up warmly, accumulate foreign exchange reserves, minimize current account deficits, etc. Now, in a way, now that we're kind of 25 years beyond that debate at the late 1990s, beginning of the 2000s, we're in a situation now where many emerging economies have learnt those lessons, have completely endogenized those lessons, so that reserves accumulation is a priority for many policymakers. Minimizing current account deficits, minimizing your need for foreign exchange in the first place is a priority for many policymakers. And so actually the indicators of financial vulnerability look much healthier for emerging and developing countries as a whole today than they did in decades past. In other words, countries have learned the lessons of history. However, that is less true for poor countries, and particularly for sub-Saharan African countries. I mean, the IMF makes an assessment now that within sub-Saharan Africa, there are now 20 countries at high risk of debt distress. And so the lessons that were learned by middle-income developing countries about how to survive in a global capital market characterized by lots of volatility, those lessons are just much more difficult for poor countries to act on. And so, we're in a situation where, debt distress these days is a feature of poor countries in the developing world, rather than kind of more middle income developing countries.
Yeah. Well, I don't know if there's any lessons we can draw from the history of those middle income countries at the time that African countries could now turn to.
I mean, the lessons from certainly the lessons of the 1980s debt crisis are difficult to apply in this case, because the nature of cross-border lending in the 1970s that gave rise to the 80s debt crisis was very different from the nature of cross-border lending these days. Back in the 1970s, the financial institutions that were doing the cross-border lending were overwhelmingly private commercial banks. I mean, you mentioned petrodollar recycling. The petrodollars entered the international banking system. The banks, flush with new sources of liquidity, needed to do something with that liquidity, and they lent it to developing countries who needed the money in the 1970s. So back then, the creditors were international banks, but the creditor base for the creditors that are actually extending loans to developing countries these days are much more diverse. It includes bondholders, it includes China Development Bank, the Chinese Exim Bank, and other lenders. It's a much more diverse group of creditors. The policy issue for China now, I think, is the fact that although in the past it was extending loans, it was extending net loans to developing countries, and that became controversial because of, you mentioned the phrase debt trap diplomacy. Now the problem is not, the issue is not so much whether the right way to characterize China's financial relationship with developing countries should be described as debt trap diplomacy. The problem now is that China is now a net taker of funds from the developing world. Last year, developing countries made net repayments to China of something like $35 billion. So China is no longer a net supplier of external funding to developing countries, and that obviously creates some challenges for the developing countries who had become somewhat dependent on China as a source of external financing.
Yeah. Well, that's very very thoughtful, and a thoughtful note to end on, I think. This was very interesting, and I was so happy I could have the chance to interview you, since I read this book and was so fascinated, and I got so many ideas of historical lessons and how they can help us to better understand the challenges that we face today. So, David Lubin, thank you so much for coming on the European Guanxi podcast.
Thank you very much. It's been a pleasure to talk to you.